Warren Saevitzon here. I'm a stockbroker and investment manager at Afrifocus Securities, and I've been investing in the stock market since 1995. Happy New Year! Wishing you and yours a successful 2023 with good health, wealth, and happiness. Speaking of wealth, 2022 was certainly not a great year for many investors. The S&P 500 closed down minus 19.4% in 2022. The South African stock market, however, performed far better, with the JSE All-Share Index down only minus 1.2% for 2022, driven by strong returns from the likes of the coal miners like Exxaro, Glencore and Thungela, retailers such as Woolworths and Shoprite, banks, notably Investec and Nedbank, a nice recovery towards the end of the year from Naspers, and Tiger Brands and Bidvest also showing good investment returns in 2022. On the negative side, Anglo American, MTN, Mondi, Spar, Capital and Counties, and Aspen all showed negative investment returns for investors in 2022. Returns were affected by global macroeconomic news, especially the complete reversal of the US central bank's, the Fed, decision to reverse the very loose, dovish monetary policy they started implementing when COVID-19 lockdowns started at the beginning of 2020 to combat the economic fallout of the virus. This has led the Fed to the fastest hiking of interest rates in the US in many decades in order to try combat inflation. One thing the stock market does not like is rising interest rates, especially growth stocks, IT stocks, and anything speculative, such as the bubble we have seen recently in cryptocurrencies, electric vehicle, and other hyped-up sectors whose stock prices were inflated by cheap money available in 2020 to 2021. In addition, the invasion of the Ukraine by Russia pushed energy prices, oil, coal, and gas to elevated levels, which exacerbated the inflation problem. China's strict lockdown measures to try combat the spread of COVID-19 as well. Looking to 2023, what could potentially unfold? Well, looking into my crystal ball, we can speculate about what might happen. The Fed in the US is likely to keep interest rates moving upward until they feel satisfied that inflation is under control. While inflation in the US has probably peaked already and has started coming down, the Fed's long-term inflation target is 2%, and the CPI inflation in the US is currently at 7.1%. So there's potentially a long way to go before they stop raising interest rates, and as mentioned, that is usually not good for the economy nor the stock market. However, the Fed does have a dual mandate: to keep inflation at acceptable levels and also to keep employment at acceptable levels. Currently, unemployment in the US is at only 3.7%. The Fed would tolerate 4% apparently, so as it currently stands, they would be okay to keep raising interest rates for the next few months, even if that increases unemployment. However, towards the end of the year, if we see that the economy in the US is getting significantly worse, particularly if unemployment starts rising above the 4% level, and if inflation continues falling, then at that point we could probably see the Fed becoming more dovish and start talking about putting an end to interest rate hikes. The other recent macro theme we have seen is that China has started reducing their strict COVID-19 lockdown policies and started making a move towards reopening the economy again. The Chinese government has also started becoming less hostile towards the large tech and other companies. In Europe and the UK, the recent fall in oil and gas prices should help alleviate some of the extreme inflation pressures seen in 2022. So then, how does one invest according to these potential scenarios unfolding? The US stock markets are likely to respond to economic data from a bad news is good news viewpoint. In other words, if the economic data that comes out is worse than expected, then that should be good for the stock market and vice versa. If the economic data is better than expected, that will probably be bad for the stock markets because that would incentivize the Fed to keep on raising interest rates. So keep a close eye on inflation and economic data coming out of the USA for the market direction in 2023. So strategy, how do we play this? Assuming inflation remains sticky in the first quarter of the year, one might want to invest in the more defensive and value sectors such as healthcare, consumer staples, telecommunications, and real estate for the first few months. Also in the first few months, one might want to invest in the Chinese reopening story. This would include Chinese tech and property companies, as well as global diversified mining companies that would benefit from the economic growth in China. Later in the year, if inflation in the USA does continue falling, one might want to change course, sell some of the defensive companies, and start investing in the growth companies such as tech and consumer discretionary, the ones that were beaten down really hard in 2022. If the energy companies become oversold, it might be worth picking some up, bargain hunting as well. Furthermore, assuming inflation in the US has peaked and started to come down, that scenario would benefit government bonds as well as gold because the dollar would get weaker. What could go wrong? Of course, predicting the future is impossible. Nobody can do it accurately, so we have to consider what might happen that would turn the strategy mentioned above on its head. Number one, inflation in the USA could remain high or even start increasing. This would be a clear negative for equities. Number two, the US economy could remain strong and unemployment low. This scenario would give the Fed more ammunition to keep interest rates higher for longer. And number three, geopolitical black swan events that very few people can predict. Hardly anyone saw the COVID-19 pandemic coming, nor the likelihood of Russia invading the Ukraine, nor the dramatic change in policies from the Chinese government. All these events over the past few years have significantly affected companies' share prices. Any new escalation of geopolitical events could change what happens on global and local equity markets in 2023 and to individual companies' share prices. So which companies do we like in each sector, both locally and offshore? We invest for clients both locally and offshore. I manage portfolios for clients and give advice to clients as well if they want to manage it themselves but want a bit of someone to talk to before they make a decision. If you'd like to know which companies and exchange-traded funds we like in each sector and why we like each company, you're welcome to email me at warrens@afrifocus.co.za. That's warrens@afrifocus.co.za. Or schedule a phone call or WhatsApp me on 082-527-5539. Happy to discuss your portfolio and give any recommendations or suggestions. Look forward to hearing you. Hope you have a fantastic 2023.